Generation Success, Women in Multifamily, MHN's monthly podcast series dedicated to the women shaping the future of the industry. I'm your host, Laura Valean. Supply pressures are beginning to ease in many markets. Transaction activity is showing signs of life, and investors are once again reassessing where and how to deploy capital. But with financing costs still elevated and performance varying widely across the Sun Belt, identifying the right opportunities requires both discipline and conviction. My guest today is Elizabeth Roy, the newly appointed Chief Investment Officer at American Landmark Apartments. How does she approach risk in today's multifamily market? And what will shape American Landmark's next chapter of growth? Let's find out together. Hi, Elizabeth. Thank you so much for joining me.
Hi, good morning. Thanks for having me.
I know you recently transitioned into your new role at American Landmark, and you have a lot of institutional real estate experience since you've worked across investment banking, lending, real estate investment management. Which experience most shaped the investor and now the CIO that you've become?
You're right. I've been in a lot of different seats. I started in the industry as an analyst in a real estate banking role, and I've moved through a few different capacities. I think that having that flexibility to move from large institutional organizations to smaller places has really taught me a lot. It's shown me different angles, predominantly how the debt side looks at things, how the cost of capital varies across different institutions, but it's given me an incredible credit background, and being able to see both the credit side of things and the equity side of things gives me a unique perspective. I would say that probably being at some of the larger institutions, it teaches you about the flow and how to manage both your time and your returns. But there's really valuable lessons to be taught across each type of player.
I know earlier in your career you built and led a floating rate lending platform that originated and sold more than 3 billion in CRE close securitizations. What did that experience teach you about building an investment business while remaining disciplined around risk?
There is true beauty in being a creator of an organization, and I was able to join a small team and grow it into a team that was 4 times the size of the group when I joined. I worked as a right-hand person to build the real estate group, and I saw a lot of metamorphosis during this time. We initially were doing CMBS style lending. And then when that industry got squeezed, we moved into the CRE CLO space doing multifamily bridge loans. And we were able to cater to a time in the market where there was compression along interest rates and cap rates and just an incredible amount of movement that enabled us to capture good premiums. It was fascinating to me to do kind of soup to nuts for an organization. So everything from hiring our analysts and our underwriters to working with the rating agencies and being able to work with them and see how we can properly rate securities. And then there was different introductions of risk retention and seeing what the bank was willing to do. But really being able to morph from one type of group into another group and grow and capitalize on the trends and the headwinds and the tailwinds in the market was something that really impressed upon me how I enjoy the entrepreneurial side of real estate.
So you've evaluated real estate from both the debt and equity sides of the capital stack. What do you see in a multifamily opportunity that an investor with a more traditional acquisitions background might overlook?
Yeah, I think that might be, some of the special sauce that I can bring to this role, that I've been able to have a debt-oriented lens for a long time. And so when I evaluate multifamily acquisitions, I can think through how a lender is going to be viewing the asset. I can think about the different components of the capital stack that are at our fingertips to use. I obviously have a substantial amount of connections in the industry. And so while our firm has done a lot of agency lending, we can look to expand that into other forms of debt as well. That being said, I think, one of the beautiful things is that my background enables me to see both the, how do we not lose money side in addition to the how do we make money side
Yeah.
and how do we transform assets. And so that's a really unique perspective that I think I can introduce here and make us even more successful than we already have been.
Right, right. I know you have a career that involves more than 6 billion in transactions. That's impressive. And that I bet it rarely unfolds without difficult calls or setbacks. Um, can you share a professional challenge that changed the way you assess risk or lead a team or just make decisions in general?
Yeah, I've seen different cycles, and I think that it really humbles you when everything's going fine, and then the next minute, nothing is going fine. And I think one can internalize that, but the reality is there are market forces at play that can impact everything from how you're pricing a deal to the office politics, to where the markets are headed. As I mentioned a second ago, from CMBS to CRE CLOs and balance sheet execution. So there's just different forces in the backgrounds that really impact all of our careers and the investment decisions that we make. I started out at a time when CMBS was really booming, and then shortly thereafter in the 07-08 window, I remember receiving an email from our trading desk saying, I hope everyone is buckled in, get ready for some, turbulence ahead. And man, were they right.
Yeah.
That 09 to 11 cycle, I think it's like a career teaching experience about how things can be up here and then all the way down there, within a very short period of time. So I think being disciplined in one's underwriting and how we do acquisitions is really just the only thing you can do, right? Because we can only plan so much for the unexpected. Like things are unexpected for a reason. But it's about being positive, about looking at both the downside and the upside. I think a lot of folks out there underwrite to where they think cap rates are going. And I think at the end of the day, you can only look at your operational excellence and making sure that your underwriting fundamentals are strong, rather than, waving a magic wand and thinking there's going to be cap rate compression or some, incredible movement that your asset's going to do better than the market. So, I think it's about being disciplined and kind of making sure that we don't forget about the GFC and other market cycles.
Mm-hmm. Mm-hmm. Um, I'm really happy every time I see another woman who has accessed the C-suite, and being a woman in the C-suite in finance is even more rare nowadays. Because institutional real estate and finance have historically had relatively few women in senior investment roles. Where did you encounter the greatest barriers in your own career, and what helped you move through them?
I agree. It's unfortunately rare for women to be able to join the C-suite. But that being said, I'm honored to be in one of those roles, and I think I, throughout my career, have tried to be positive, to work as hard as I can, and to make the right connections. Unfortunately, like, half the battle is doing the work, and the other half are your relationships. And so, women need to kind of push forward and make sure they're making those connections and not think that I myself have made the mistake that my work stands on its own, that I've originated an incredible amount of great deals and have a great track record. But at the end of the day, it's really about being out there, about talking to people, about being your own best advocate. making sure that other people know who you are, being open to do interviews on great podcasts, and being open to move your career around. There's not a magic ingredient that you can kind of say, hey, do this and you can join this group. It's about showcasing your positivity, about your showcasing your talent, about being innovative about ideas and open-minded to kind of the trends of the market and being flexible within organizations. But I think there's great positive momentum out there right now. And I think, more women will be joining your podcast soon.
Yes, I sure hope so. And all that hard work has now materialized in your new role. You're stepping into a newly appointed CIO role at a company with an established investment platform and more than 36,000 apartments. What do you believe a new investment leader should understand before deciding what needs to change?
Yeah, it's really an honor to be part of such a large organization that's been around for as long as it has. So clearly, things have gone right for this group for a long time. And when joining at the C-suite level, it's important to evaluate what has gone right, what has gone wrong, and to not take the approach that everything needs to change, but just think about bringing some of the strengths that I've seen in other organizations, some of the institutional components, to really fine tune the organization rather than make dramatic changes. And so for me, in particular, it's about bringing some of the underwriting skills and some of the operational attributes that I've been able to be privy to at other large organizations and bring them here and just kind of tweak the organization and kind of guide it to create like just a better trajectory rather than slicing and dicing and slashing. I think there's so much that is right about this organization, and so we are going to continue to make it better and refine it. But it's a very strong platform to start with.
And actually, American Landmark describes its strategy as, and I quote, disciplined, value-driven investing supported by a vertically integrated operating platform. How do you plan to combine institutional underwriting rigor with the market level knowledge coming from the operating teams?
I view it as a true privilege to be able to see the value that our operations team has generated. It is an outstanding group of people in all of our markets. They have done incredible work. We own and operate all of our properties, so we don't do any third-party management. And the good thing is that keeps the special sauce internal. Our teams are very communicative. We are very good at data collection. It's been really eye-opening to be able to use our AI tools to evaluate what has gone right and what has gone wrong on a property by property and market by market basis. And so we've been able to do some analysis kind of coming in day one for me and look at, how do we apply what has gone right in certain assets or markets to other assets and markets where maybe there's been a lot of supply, maybe there's been turnover in our management teams. So there's a lot of AI tools that we've been able to incorporate that has made us a more capable operator. But all of our operations are very strong, and I think that's really kind of our ability to move into the future, acquire more assets, and use our team to manage those even better than they have been.
Let's dive deeper into some specifics. For example, when you look at potential acquisitions today, which assumptions require the most scrutiny? Concessions, financing costs, rent growth, the exit valuation, you name it.
Yeah. Look, I think we take a fine-tune approach to every metric that we're underwriting, and I'm laser focused on making sure that our performers make sense and stand up to not just lender scrutiny, but really investor scrutiny, which is probably even more intense than the lenders. I think rent growth is a big one. We take a very micro market approach. So it's really block by block where we think there's growth. And, maybe a new hospital's popping up on the block that we're on, or maybe, things are changing for the worse, right? So we're not going to rely on what some, huge market, top down kind of approach, but really that bottom up. What is our boots on the ground operations team saying about a specific location? So on the rent growth side, we have a lot of data. We've kind of stayed true to the markets that we've been in for a long time. And then as far as the operations, as I mentioned a second ago, our team is phenomenal. We have so much data. Our insurance premiums are probably some of the lower ones in the industry. Real estate taxes are what they are, but we have a strong appeals process. So we kind of look very carefully at the real estate taxes on each asset. As far as our other operations go, I mean, one of the things that we do in our strong suits is that we will move forward with our value add capital improvement program day one. So we try to push forward all of our innovations within a very rapid period of time so that we can see the pops in the rents relatively quickly relative to other operators. So we're very focused. We have an in-house team that does those renovations. So we're very conscious of the costs of solid surface in the kitchens, new bathrooms, what the flooring is going to cost. So we have that really nailed down. And we buy a lot of, or pretty much all of those ingredients kind of early in the year. And so we're not as subject to the fluctuations of inflation and costs kind of going forward. We do pay a very careful eye on each of those line items costs, and it's not a broad brush 3% increases, but we kind of know what the American landmark costs are going to be when we're evaluating a new acquisition opportunity. I think, the wild card is always interest rates, right? Because we have to underwrite, some number and nobody really knows. Like there's been just an unbelievable amount of volatility in the markets this calendar year. We've seen sort of an expectation walking into the year that rates were going to be diving, and then we've engaged in wars and other things have happened, and we're at this back to the somewhat of a market standstill of like, wow, where are rates going again? The Fed held, but are they going up later in the year? It's really anyone's guess, where rates are going to move.
Yeah, everyone is trying to get accustomed to this higher for longer interest rate environment. It's just what the rates are now. Just get used to it and start making deals, I guess.
I think that's accurate. I think that's accurate that there's not the ability to necessarily predict, but it's just like create your return based on like this is where rates and cap rates are. And, it forces operators like us to really rely on our operational expertise versus like guessing that cap rates are going to compress.
Right. Right. And many markets are moving beyond the recent wave of apartment deliveries because you mentioned markets with a lot of supply. The recovery is unfolding unevenly. How do you distinguish a market experiencing a temporary supply overhang from one whose investment fundamentals have genuinely weakened?
Yeah, I mean, we are the beneficiaries of really the job growth and population growth in the Sun Belt at large. And generally speaking, there has been this movement of folks from colder climates to warmer climates. And the states that have created the most incentives, have favorable income tax policies, are just going to continue to see growth into those areas. So it's people or operators started building in the markets where they foresaw that growth, and it feels like there is an oversupply in most of those markets. But the reality is that that has dried up, and so we're seeing less supply coming online in pretty much every market that we're in. And so the folks are moving into the apartments, and we're seeing less of an issue with that. It feels like, yes, it is market by market, but it's kind of across the board that we're seeing that. And our rent growth is starting to catch up, our occupancy is growing. Yes, there are some that are stronger or weaker than others. We have an incredible amount of data here internally with our, I think we're up to like 38,000, if not closer to 40,000 units at this point. We've made a number of acquisitions this year. But we have great data kind of supporting that thesis, and we anticipate that supply to continue to drop in the next couple of years. That will further strengthen the investment thesis in the Sun Belt.
The industry seems to be talking a lot about an impending increase in transaction activity. What would you say still needs to happen for buyers and sellers to reach that greater alignment? I know there's been a huge gap between their expectations. And where are you currently seeing the most credible acquisition opportunities?
Yeah, that gap between the bid ask, it's been around for a while, and I think folks just have had to acknowledge that things are higher for longer. And if you look in the history of the 10-year, I mean, we're not actually in a place that's super high. It's just that for some solid amount of a decade plus, like rates were just lower, right? And so people felt like this is just, where normal is, but normal has to be assessed with a longer lens or a larger lens. And so I think it's just a challenging place to transact, but with money starting to return into the multifamily and the commercial real estate space after it's been chasing AI and tech for some period of time, the returns have to be remeasured, and there are opportunities out there. And there are markets that I really like and want to see us focusing a little bit more on in some of the growth states that I mentioned, some of the Carolinas and Tennessee. There seems to be continued activity there that suggests to me that with more job growth, there's going to be more demand for the type of Class A multifamily that we own and build and operate. So I think that we will see continued growth in those markets, and more players will come to recognize that that is the spot to be and buy assets.
Yeah. Financing will remain expensive for the rest of the year at least. That's what everyone expects. So rent growth is harder to obtain now. How is the value add multifamily thesis evolving in that context? Where can owners still create meaningful returns without relying on aggressive rent assumptions?
Yeah, there's two places for that. I mean, I don't think that the distress story ever fully materialized in any kind of a wave that people anticipated with the refinances from folks that took out debt in the 21-22 era when rates were super low. But that being said, there are certain opportunities for where people do need to transact because loans are coming due or equity partners need cash back. And so we're seeing, American Landmark has a lot of feelers and connections out there. And so we tend to just see all of those deals in the marketplace before others do. We have the ability to transact very quickly as well. So there are some distress opportunities out there that can generate over market returns or generate alpha for us. In addition to that, I think there are weaker operators or property managers out there. And so we can come in, buy an asset, create value, do incremental, costs aside from the rent that help drive our NOI. So I would say that those are the two opportunities, just like some distress out there, not the flood that anyone anticipated, and then also just operations and fees.
One last question, Elizabeth. Looking ahead 3 to 5 years, where do you have the greatest conviction in multifamily? And what risk do you think the industry may still be underestimating?
There's an incredible cost basis play right now. And so you can acquire new Class A assets for a below cost basis. And as the market continues to create more jobs and fundamentals improve, I think if assets are acquired at the right basis right now, that really will serve operators well in the 3 to 10 year horizon when you have a virtually brand new asset and those rent fundamentals are right back because nobody's going to be delivering supply in the next like 2 to 5 years, right? So we're going to
Yeah.
go from an overhang to an underhang, and then who is bought now is going to look pretty smart. So we have some assets that we're looking at acquiring that are basically brand new from developers, like some lease up stories, and we think that those are going to really create a attractive basis for future valuations.
Thank you very much, Elizabeth. This was a great, useful conversation.
Thank you so much. Thanks for having me.
Thank you for listening to the August episode of Mission Success Women in Multifamily. If you enjoyed this conversation, check out our website on the third Thursday of every month for another inspiring story. And to make sure you never miss an episode, just follow the Lease Up on your favorite podcast platform. That's where you'll find all of Multi-Housing News' podcast series, including Mission Success. Thanks again for watching. Till next month.